monitoring price action. Now, in today's class, I'm going to use the term security, but I'm also going to use the term euro, or I might say Bitcoin, or I might say Facebook, but I'm not referring to any particular asset. I'm talking about any publicly traded financial instrument in which an open market exists. Similarly, I intermix the terms investing and trading. Since we're all here part of Legacy FX, we are traders. Okay. Traders take short-term positions and hope to make profit on the moves of the asset, or an investor takes a much longer-term position. We know the difference. Now, the question everybody asks me when I'm doing a webinar, whether I'm doing a seminar, whether I'm doing a conference, whether I'm doing one-on-one trading or a meet and greet, everybody seems to ask me, what should I buy today? I think this morning at 5 o'clock in the morning, I already got an email saying somebody tell me, should I sell my Bitcoin? It rallied up to 8,400. They want to know what prices will be tomorrow, next week, or next year. Well, wouldn't investing and trading be easy if we knew the answers to these seemingly simple questions? But I'm going to be honest with you. I don't have a Ouija board, and I don't have a crystal ball, and nobody that tells you they do is honest with you. Nobody can predict what price is going to do, because price is random and it's full of human psychology. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I've got good news for you. That it surely will. Now, technical analysis is a great big word that scares a lot of people away. It makes people think of long process and lots of education. So technically for technical analysis, actually, I use the word chart analysis, because technical analysis is anything and everything that you do on a price chart. Whether you're just simply looking at a line chart, or whether you're looking at a complex candlestick chart, whether you're using a simple moving average or an indicator oscillator like MACD or RSI, all of it is part of the study of technical analysis. So to not be afraid of it or not to be scared by it, simply say it is anything and everything we do on a chart. Now, as recently as the 1980s, brokers and traders charted the movement of assets by hand with nothing but graph paper and pencils. And when I started trading, that's what we did. We sat in the pit at a broker's office. We didn't have any computers. You know, a broker had this big room full of air-conditioned equipment, and we had some screens, these MS-DOS screens, but there was no internet. So there was no data feeds. And we were watching prices come across on the ticker tape. And we were sitting there with our graph paper and pencils and paper and drawing lines on charts. So in less than 4 decades, the charting industry has revamped several times. Now today, we have these advanced HTML and Java charts that have data feeds right into them that'll do everything but show us economic events right on our chart to news headlines on our chart, that will drop every indicator and oscillator on there, find chart patterns. It'll tell you when a Japanese candlestick patterns are developed. They do everything. So an online trader like you or I today has access to the same charts that professional traders, banks, and hedge fund traders have, and with the same data just as fast as everybody else is getting. Now, charting software allows those in any market to see price moves, observe changes of various stretches of time, and combine this information to conduct market analysis and prediction. Okay, now why are we talking about charts, you may ask? Because it is the basis of all price action. Because if I were to say to you, the euro is trading at 111.42 and it opened at 111.07 and it went up to 111.57 and it fell down to a low of 111.02 and then it closed at noon at 111.44 and now it's at 11.140.52. Could you repeat that to me? Could you just visually in your head see what price is doing? No, but if I were to take those 8 little numbers and put them on a chart and put a dot and put them on a chart, I'd be able to see exactly what price was doing. I'd be able to imagine where it was going. I'd be able to see some commonality with prices, and I'd be able to see what was the highest and the lowest and what the close was. Because this is one of the true cases that a picture is worth 1,000 words. So it's an absolute necessity for carrying out intelligent trades. Without it, trading any asset would be more like gambling because we would just be dictated by chance. So expect to use a lot of time reading trading charts, which is much like learning to read a new language. Once you've put in the work, you will be able to fluently interpret the information on the screen. You'll be one step closer to executing successful trades. Any newbie trader asks which chart setup is the best of the best. And experienced traders say that such a panacea simply does not exist. Now, there are different types of charts used in technical analysis of the CFD market or of any Forex market, cryptocurrency market. Some of the most common ones, and the most that we ever talk about, there are some random exotic charts out there, but they fall into the category of line charts, bar charts, and candlestick charts. Now, a line chart does us not much good. Because a line chart simply takes the close of each time frame and puts a dot on the chart and connects those dots together. So we can see a general look of how price is moving, but we can't see any commonality in price. We can't see anything that tells us anything. From there, we go to the two most used charts. Now, when I started trading, bar charts is what everybody used. Today, everybody uses candlestick. It's the buzzword of the go-to chart for the online trading market. But all the charts use the same data. There's no different data on a candlestick chart than what you have on a bar chart or on a line chart. It's just the visual representation. So a line chart's are good at giving a quick view of the overall market trend. So a line chart is simply a line drawn on the market, on the chart. Now, let's go over to a live chart. It's easier for me to show you this on a live chart. So let's go pop up a live chart here. And we're going to be looking at my Euro US dollar chart. This is my standard teaching chart. Euro US dollar 30-minute chart. And I'm going to change it over to a line chart. So as you can see, let's get rid of the indicator below. Just to make more space on the chart. Now a line chart, in trading generalities or in trading history or in trading understanding, a line chart uses the close of each period in your time segment. So we're looking at a 30-minute chart. At the end of the 30-minute period, the close, we put a dot on the chart. But because we have all of these newfangled computer charts with IT developers and software developers that are looking to do everything and anything new, that really have no value to us. Today, we have a line chart that we can put on with the close. We can use a line chart with the open, the high, the lows. We can also use the high and the low divided by 2, the high, the low, the close divided by 3, or the open, the high, the low, and the close divided by 4. None of it has any value to us. Now, you might find some guru in the market telling you to do something, but believe me, it doesn't. Because a line chart simply puts a dot on the chart. From here we go to my favorite, which is the bar chart. Now today you'll see bar charts that are green and red just like candlesticks, but they look like bars. But the way bar charts were is how we saw price. And the thing I like about bar charts is they're not cluttered. And we can easily see price that has some commonality. We can easily see numbers that were important that move together. We can easily see trends. We can easily see the overall picture of a market. So there's a lot of things we can see in a line chart, in a bar chart. Now, each one of these bars uses the open, the high, the low, and the close, or it's referred to as the OHLC. But this is the only data that anybody in the market has. Everything and anything we do in technical analysis uses the same pieces of information: open, high, low, and close, and then volume. That's it. Now, what we do with a line chart, a bar chart, is we put a dash to the left at the open price. We put a dash to the right at the close price. We put a dot at the highest price and a dot at the lowest price, and we connect the dots together. And that gives us the formation of the bar. Now, if we stepped up from the open to the close, that tells us it was a bullish period. If we had stepped down from the open to the close, that would tell us it's a bearish period. Okay. But there's lots of things we can do with bar charts. But remember, what we're looking at here is a visual depiction of price action, of how price is moving in the markets. So by simply glancing at the chart with no other analysis on here, we can start seeing things, we can start predicting things, we can start interpreting price. I mean, look at what's happened with the euro US dollar today. Okay. We see a very strong downtrend. We can start to predict what prices might be next in this run. We can understand this. You couldn't have understood if I just jotted off. There's, let's see, we're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 bars. 15 bars consist of 4 numbers each. That's 60 numbers. If I were to ramble off those 60 numbers, your brain couldn't absorb it. But here we see it. From here we go to the most popular chart in the marketplace, and that's called the candlestick chart. Candlesticks are the buzzword for online trading. Now, traders like them because they're colorful, and they think by looking at reds and greens they can interpret the market. But candlestick charts have very little to do with that. And unfortunately, this is the misnomer and gets in the market and gets people in trouble. Candlesticks are all about the shape and the size of the candle. So as you see, this one's got a small body, this one's got a very big body, this one's got no body. Then it has to do with the relationship with the previous candle and the current candle, okay, and where it stands in the trend. Now, there's lots of ways we can interpret this market, and there's also with candlesticks, there's something called pattern recognition. Okay. I'm not a believer in pattern recognition for our type of trading because it means memorizing lots of patterns, and every time you see that particular candlestick pattern, you're supposed to do something, but it doesn't really work that way. Okay. It's too time consuming, too much memorization, and the markets just don't respond that way. But we have candlesticks, and whether you're looking at a line chart, a bar chart, or a candlestick, this is interpreting the psychological and human element in the market, because there is nothing else. It's a bunch of human beings all over the world making decisions. And once we accept the fact that price is random, that price moves all over the place, and then we accept the fact that there are certain times when price moves in non-random movement, and these are called trends. Okay. When we have an established trend, okay, that's telling us that that current time, that short period of time, we have some non-random movement. We have movement that we can actually apply interpretation to. Because to be honest with you, this mess this mess and this mess, we couldn't really make any interpretation. And the market spend its time mostly in messes. Okay. Now, the fact is, there are millions of trading choices all the time. Okay. If we're only looking for high probability successful trades, then we don't care about finding some trading opportunity in this mess or some trading opportunity in this mess. Why would you want to do that when there's always an asset you can trade? When you see an asset being pushed up and the markets have jumped in there and the traders are jumping in there, exerting all that energy to push it up, why would you want to be trading in here where you can't even understand what the traders want to do? Here, there's a lot of things pushing the market down. It's non-random movements. Okay, when the market is non-random, we can start interpreting price action. So let's go back to my PowerPoint. Oh, okay. And the only time we're going to be able to see these non-random movements is by looking at our charts. So it's really line charts don't do much for us. But whether you want to be a bar chart trader or a candlestick chart trader is completely up to you. The fact is, like I said, I told you bar charts are my favorites. But I am constantly, because today, back in the old days when we were hand charting and drawing everything by hand, you couldn't jump from one thing to another. In fact, just a couple of years ago, you couldn't either. Okay. But now that the computer charts are so advanced, all we want is I can put all my trend lines and all my technical indicators on my charts. And I can click back and forth from candlesticks to bar charts, from bar charts again. I can even change time frames. I have all the flexibility in the world. Now, time frames are very, very important, okay, because a time frame on a chart breaks down the period in which you want to see and interpret action. In other words, if the euro is trading at 110 at 1 o'clock and at 2 o'clock is at 111, if you're looking at a 1 hour chart, all you would see was that 110 and the 111. If we broke it down into half hours, we could see that maybe from 1 to 1:30, it didn't move at all. And all that price action was only from 1:30 to 2 o'clock. Okay. We start to see smaller movements and smaller increments. But as we get closer in, we can see less in trend action. So this chart is exactly the same as the other chart, except it's got the price once every hour instead of once every half hour. If we go back to a 1 day chart or go back to 1 day chart, then we go back and we see a lot more definition. We can understand environmentally how an asset is moving. Now, the thing is, see all those lines that are drawn on my chart? Those are long-term technical analysis or support and resistance levels, and they stay on my charts. Here I have something I drew in here quite some time ago. Let's go back to a 4 hour chart, and we can then see or interpret the different price action over periods of time in different time frames. So today, like I said, we have lots of flexibility. We use candlesticks and bar charts, 30-minute, 1 hour. Like I said, in the old days when I was hand charting, you didn't have the ability. You wrote down the price every 1 hour, and that's what you traded with. If you wanted to be a half hour, you were writing, because you were doing everything by hand. You didn't have the ability to break down things and see short-term direction and long-term direction and medium-term direction. So the structure for all trade charts is pretty much the same. It's the same numbers, high, open, high, low, and close. It's all dropped on an XY axis and put together. Because once we have the chart, we then want to see certain patterns that appear in price movement. Okay, so as we jump in to price action, we need to be able to interpret what we see. Okay, and there's many ways we can do that. One of the most popular ways of interpreting price action is using patterns that we see in price movement or in charts. Because price action is the movement of an asset's price plotted over time. Price action forms the basis for all technical analysis, whether it's a stock, a commodity, or other asset. Price is the ultimate dictator of everything. So many short-term traders rely exclusively on price action and the formation and trends extrapolated from them to make trading decisions. Technical analysis as a practice is a derivative of price action since it uses past price and calculation that can be used to make informed trading decisions. Price action analysis is the act of studying, reading, and interpreting the price movement of a market over time, which involves the use of raw price charts to trade the market. That means with no indicators. By learning to read price action of a chart, we can determine a market's directional bias as well as trade from reoccurring price action patterns or price action setups that reflect changes or continuations of market sentiment. So once we can read what a chart is saying to us, and once we can see some commonality in these lines, we can start seeing things that give us patterns. Like here we have a very well-known accepted pattern called a triangle. When we get this formation of a triangle, we can interpret what to expect in the markets. We also have things like support and resistance areas. These are prices where these are areas or zones when price has been moving up or down, the price has gotten stuck historically, not necessarily today, but last week, the last time price was trading, it could be a year ago. Look, we know gold at 1,500 is a very important psychological level. So when gold's over 1,500 and falling down, okay, we expect it to be supported at 1,500. Okay, when it's down below 1,500 and moving up, we expect that resistance at 1,500. So think of support and resistance as like the floors of an elevator, the floor below your feet and ceiling above your head when price is going up. When the elevator is coming down, it's just the reverse. Okay. And by looking and analyzing time and movement and past movement, you can make intelligent decisions. Like if you knew that an elevator in a high-rise building, okay, if you knew in a high-rise building, in the 17th floor, there was a big restaurant. On the 21st floor was the roof where the smoking deck was. You would expect, or you could estimate the probabilities of that elevator stopping on the 17th floor and stopping on the 21st floor. Now, if you knew that that restaurant only served lunch and dinner, and it was lunchtime and that elevator was moving up, it increases the probability that that elevator will stop at 17. If it's early in the morning and that elevator is going up, chances are it's not going to stop at 17, but it's probably going to go up to 21 because all the people in the office that came to work are probably running outside for their first cup of coffee and smoking their cigarette on the roof deck. Okay. We can start making informed decisions about what we expect price to do. So by noticing these patterns, we can start interpreting price action. And these patterns are well-known, well-defined movements that help us interpret price action. So all economic variables create price movement, which can be easily seen in a market's price chart. Whether an economic variable is filtered down through a human trader or a computer trader, the movement that it creates in the market will easily be visible on a price chart. So in other words, if I know that the U.S. jobs report is coming out at 1 o'clock on Friday, okay, I don't need to look and see what the results are. I can see it on my price chart. Okay, I can see the movements in price and how the markets are reacting. Therefore, instead of trying to analyze a million economic variables each day, you can simply learn to trade from price action analysis, because this style of trading allows you to easily analyze and make use of all market variables by simply reading and trading off the price action created by the said variables. Now, I want to mention to you, if you look on your screen, you can see on a little place where it says handouts. I've put together two very, very nice handout reference guides for you. There's nothing you have to do to get them. They're free. There's no registration. Just click the download button. They're PDFs. And one is the Introduction to Technical Analysis from Investing.com. It is an outstanding resource material. It's not just a simple little ebook. It's a big reference book. Then I've also put together for you a grouping of the 5 top technical indicators. Now, in technical analysis, when you move from chart patterns and support and resistance and trend lines over to putting the mathematical variables that are called indicators on your chart, these become another part of interpreting price. Now, I explain technical indicators as interpreters. So in other words, when you're looking at price action and you're looking at support and resistance, you're looking at patterns, you're looking at the actual movement of price, and you can't interpret it. It's not clear to you what it's trying to say. You can apply these indicators and oscillators that will help interpret it for you. There's secondary uses, even though too many people use them as primary uses. There's like RSI, stochastics, MACD, Bollinger Bands. But these are mathematical calculations that are then dropped on your charts. But they will help you to verify your trading decision, or they might help interpret what you can't see in the market. So price action can be seen and interpreted using charts that plot price over time. Traders use different chart compositions to improve their ability to spot and interpret trends, breakouts, and reversals. So we've looked at chart patterns, the most popular being the candlestick pattern. In addition to the visual formation for the chart, many technical analysts use price action data when calculating technical indicators. The goal is to find order in the sometimes seemingly random movement of price. Price action is not generally seen as a trading tool like an indicator, but rather the data source of which all tools are built. Swing traders and trend traders tend to work most closely with price action. And this is where too many traders get lost. They get so involved in their chart setups and they're so involved in their indicators and oscillators, they forget that ultimately the only thing that's making any decision out there is the price movement. Price movement is ultimately the most important factor in the trading. Even these traders must pay some attention to additional factors beyond the current price, as the volume of trading and the time periods being used to establish levels all have impact on the likelihood of interpretation being accurate. Volume is one of the most crucial pieces of information on a chart. No matter what trading decision you make, if it's not supported by the volume, saying other traders are jumping in the market to trade in the same direction as you, then you've got to be careful. Interpreting price action is very subjective. It's common for two traders to arrive at different conclusions when analyzing the same price action. One trader may see a bearish downtrend, and another might see that price action shows a potential near-term turnaround. Of course, the time period being used also has a huge influence on what traders see, as a stock can have many intraday downtrends while maintaining a month to over month uptrend. The important thing to remember is that trading predictions made using price action on any time scale are speculative. The more tools you can apply to your trading predictions to confirm it, the better. In the end, however, the price action of a security is no guarantee of future price action. High probability trades are still speculative trades, which means traders take on the risk to get access to the potential rewards. So the whole idea is reducing the odds, increasing your potential for a high success rate, and limiting your risk by putting close stop losses. But the whole idea is to find only the best trade, not spend forever searching it, but automatically filter out and discount trades when you don't see a strong trend. You don't see a directional movement. Go away from it, move away, and go on to find something else. So we also have price action trading signals. This method consists of a handful of very specific price action entry triggers that can provide you with high probability entries into the market, because ultimately determining what direction you trade, what price you're going to willing to enter the market, and where to put your stop loss are the keys to anything. Risk management is always the key. And looking at price will help you determine where to put your stop loss, because you can see the swing of the market, how far the asset, and where you'd have to put your stop loss to miss just getting stopped out in the continuous swing of the markets. Essentially, what we are looking for is a recurring price pattern that tells us something about what the market might do in the near future. So being able to read price action charts is important to make the right decision. The problem many traders have is that they overcomplicate things and get easily confused, or they don't have a process in the first place. They just look at charts, drop some lines in there, and they don't have anything worked out. They just randomly make decisions. So you should always be looking for swings, swing highs and swing lows in the market. That should help you put trends on the market. You should always understand what they are doing. Then always look for support and resistance. That's crucially important. Those are the floors above and beyond where price is going at the moment. Then look for price action wave analysis, because a good trend moves in waves. Now you can get really complicated in wave analysis, but I say every trend should be push, ease, push, ease, push, ease, push, ease, the peaks and the valleys. When you can see a well-developed trend, making a set of waves moving up, making higher highs and higher lows, or the opposite in a downturn, making lower lows and lower highs, then you have this non-random price movement that you can interpret. But trying to just move and trade in a market that's making any specific direction or headway makes it very complicated. And always have your trend lines on charts. If you can't see not just a trend, but a trend line which supports the price movement, then you shouldn't be trading, because the old adage in the market is the trend is your friend. And we have whole classes on learning how to put trend lines properly on your charts. And then lastly, you're using a simple indicator like moving averages. Moving averages will keep you on the right side of price movement at all times. And then here we have a confluence. We have 4 different pieces of information that when they come together, they might give you a chance to enter the market. Because what we're trying to do is use a filter and filter out all the bad trades. So if all your trades, every trade you're looking at doesn't fit all these filters, throw them away. So to sum it up, price action trading is a trading methodology that uses the movement of price as input for making trading decisions. It allows you to tell a story of what the price is doing and make high probability trades based on that story. It is a form of technical analysis. As we mentioned, price action trading revolves around only using the price of the security to make an informed decision on what the market might do. But that doesn't mean we cannot look at it in different ways. So thank you very much for joining us today. I hope you learned a little bit about price action. If you have any questions, you can go to www.legacyfx.com and drop them an email or user chat, and they'll be glad to answer your questions, or User Education Center, or go to www.investing.com and enter their education department, and you can see all the classes we've ever given. But I guarantee if you download those 2 handouts, everything you want to ask is answered in those handouts. So once again, thank you very much for joining us. Have a great trading week, and thank you for supporting Legacy FX and investing.com. Bye now.